Okay, let's dive in. Today, we're grappling with a source that promises something, well, pretty compelling for anyone looking at the markets.
Yeah, significant trading profits supposedly in very little time.
Exactly. Our source material is a YouTube video. It's titled, My Stupidly Simple A+ Scalping Strategy to Make $100 Kill a Month 100% Rule-Based.
Comes from a channel called Scarface Trades,
Hmm.
and that title really says it all, doesn't it?
It really does. I mean, the core claim is you can make some, frankly, eye-watering profits. They mention figures like $500,000 in a month.
Right. And all by trading a specific strategy for, get this, just 90 minutes a day.
90 minutes. Specifically, the first 90 minutes the U.S. market is open, so 9:30 a.m. to 11:00 a.m. Eastern Time.
That's the window.
So our mission here, for you listening, is to unpack this specific strategy they're presenting, understand the mechanics, look at the claims, the examples.
See how this first candle strategy, as they call it, is actually designed to work, or at least how they claim it works for consistent profits with such a small time commitment.
First candle strategy. The name kind of gives away the starting point, doesn't it?
It really does. Everything seems to revolve around the very, very beginning of the trading day.
And that limited time window, 9:30 to 11:00 a.m. Eastern, that's central to the appeal. The source keeps saying, done for the day in 90 minutes.
Yeah, the idea seems to be that the market's initial volatility right at the open offers enough juice, enough opportunity within that short period. You don't need the whole day.
So the core setup, it involves the very first 15-minute candle.
That's it. The candle that forms from 9:40 a.m. Eastern, right when the market opens, until 9:45 a.m. Eastern.
Okay.
The strategy says you mark out the high and the low of just that single candle. That 15-minute range, that becomes your key level, your battleground, sort of.
Interesting. And they say this works for, what, various instruments?
The author states it's usable for stocks, options, futures, forex, crypto, basically anything, but you always anchor it to that 9:30 a.m. Eastern open to find that first 15-minute range.
Right? Makes sense. Okay, so you got the range. Now, the video simplifies the actual trading part into 3 steps. This is the rule-based bit they emphasize.
Exactly. Keeps it mechanical, takes out the guesswork. That's the pitch, anyway.
So, step 1, define the range. Easy enough. Draw the high, draw the low of that 9:30 to 9:45 a.m. candle. That's your zone.
Check. Step 1, done. Now, step 2 is where you need some patience, according to the source. You switch to the 5-minute time frame.
Okay.
And you wait for a breakout. But crucially, not just price poking through, it has to be a 5-minute candle closure.
So the full body of a 5-minute candle has to finish either above that 15-minute high or below that 15-minute low. A wick doesn't count.
Exactly. No wicks allowed for this confirmation step.
Yeah.
The source really stresses waiting for that closure to hopefully filter out fake moves,
Right, the fake outs. So a solid close above suggests buyers are serious.
Yep, buyers showing conviction. And a close below suggests sellers are taking control. It's presented as that necessary green light before you even think about an entry.
Okay, that tracks. Define the zone, wait for confirmed directional breakout on the 5-minute. So what's step 3? Once you get that 5-minute close outside the range.
Right, once that happens, step 3 is where you zoom in. You drop down to the 1-minute time frame.
So 1 minute, okay, for the entry signal.
Precisely. After that confirmed 5-minute breakout, the strategy says, look for the first pullback retest back to the level that was just broken, but find it on the 1-minute chart.
So let me get this straight. Price breaks above the 15-minute high on the 5-minute. You then watch the 1-minute chart for price to dip back down to that old high.
That's the idea.
And if it breaks below the 15-minute low, you wait for it to bounce back up to that old low, which is now resistance.
Exactly that. The source calls this the lowest risk entry. The logic they present is, okay, buyers just push price up through resistance. They should defend that level if price revisits it.
Trying to get in right where the move is expected to continue from.
That's the theory. Same logic. For short sellers broke support, they should defend it on a retest from below. It's an attempt to join the momentum close to the point of control.
Okay, I think I've got the entry rules as they lay them out. What about managing the trade? Risk is key.
Absolutely. And the source does emphasize this. They stress keeping a risk-to-reward ratio of at least 2 to 1.
So for every dollar risked, you're aiming for at least $2 in profit. Standard stuff, but important.
Very. And the stop loss, how do they determine where to put that?
They mentioned placing it based on either a candle closure, presumably on the entry time frame, the 1 minute beyond your entry candle, or something they call a break of structure.
Break of structure.
Yeah.
Okay, that's a common term. reads definition, but generally means the point where the pattern or your trade idea is clearly invalidated.
Right. The point where you just say, okay, I was wrong. And profit targets are generally that minimum 2.1, maybe aiming for the high or low of the day or other, quote, external levels.
Got it. So the core principle seems to be define the range, wait for the 5-meter close break, enter on the 1-meter pullback retest, aim for 2.1 R to R, all within 90 minutes.
Pretty much sums it up. And then the video tries to show this in action, right, with real examples.
Yeah, they claim to show real trading examples using this exact strategy over one specific week, day by day. Let's walk through those results as they presented them.
Okay, hit me. Day one.
Day one, they showed 2 trades, both bearish, so looking for price to go down. First one, 5-minute candle closes below the 15-meter range. Then they looked for the 1-minute pullback retest.
Okay.
They claimed they risked $200 on that trade, made $530. That's about a 2.94 R to R, and apparently done by 10 a.m.
Wow, quick work. Second trade on day one.
Also bearish, another 5-meter breakdown below the 15-meter range.
Yeah.
This time they described it as an immediate 5-meter retest that led into the 1-meter retest, noted some weak action on the 1-meter chart there.
Okay.
Risked $380 on that one, claimed a profit of $780, so a clean 2-to-1 R to R. And they said they were done trading by 10 a.m. Cumulative profit after those 2 trades, $780.
Right. $530 plus $250. Wait, no, $780 profit on the second one. Let's recheck. First was $530 profit. Second was $780 profit.
Ah, good catch. Let me reread the source notes. Okay, the notes here say risk $380, made $780 profit for the second trade, so cumulative profit is $530 plus $780 equals $1,310. My apologies. Let's correct that.
Okay, $1,310 cumulative after day one's 2 trades, according to their examples. Makes more sense with a 2R win. What about day two?
Day two, the video showed the 5-minute chart starting choppy, but eventually a 5-meter candle did close below the 15-minute range. That triggered looking for the 1-meter retest entry.
And the result?
Risking $530, the trade apparently generated $1,100 profit. Another 2-to-1 R to R, roughly. Trading finished by 10:40 a.m. Cumulative profit presented $1,310 plus $1,410.
Okay, still showing success. Day three, a different direction maybe?
Yep, day three showed a bullish example. A 5-minute candle closed above the 15-minute range high this time.
Looking for a long entry.
Right. The 1-minute pullback initially looked a bit weak, according to the description, but then buyers aggressively reclaimed the level. That reclaim was the entry signal they took.
And the numbers.
Risking $560, this trade resulted in a $1,370 gain. Again, meeting that 2.1 minimum. Done by 10:16 a.m., total cumulative profit shown now, $2,410 plus $1,370 equals $3,780.
All right, so far it's looking pretty stellar in their examples, but trading isn't always wins. Did they show any losses?
They did, and they highlighted this for transparency. Day 4 presented a bearish setup 5 meters close below the range, 1-meter retest.
Okay.
But they noted that buyers were aggressive initially at the retest level before sellers briefly reclaimed it. It was described as maybe not textbook, but still fitting the rules, so they took the trade. Risking $680. This trade was a loss. Lost the full $680 risked.
Ah, okay, so reality bites. That brings the cumulative profit down to $3,780, $680 for the week so far in their exams.
You're correct. $3,100. And then day 5 is interesting.
How so?
According to the video, on day 5, there was simply no setup that met their strict criteria within that 9.3 to 11.00 a.m. window.
Meaning?
Price just chopped around, stayed consolidating, never got a clean 5-minute candle closure outside that initial 15-minute range.
Yeah.
So no signal, no trade.
Ah, so the strategy itself kept them out of the market that day.
Exactly. The cumulative profit remained $3,100 for the week, as presented in the source.
Okay, let's summarize that week as shown in the video. 4 trades taken in total, 3 wins, 1 loss. That's a 75% win rate for that specific period.
Right, and based on those numbers, they calculated a 4.56 profit factor, meaning for every dollar lost, they made $4.56 in profit. And the total profit shown for that week was $3,100.
Okay, $3,100. And the source likely points to including the loss and the no trade day as evidence of, being upfront.
Yeah, that seems to be the angle, showing that it's not perfect, days off happen, losses happen, but the rules, if followed, allegedly lead to overall profitability based on these examples.
So, boiling it down, why does the source claim this first candle strategy is so effective, or at least appealing? What are the main selling points they push?
Well, number one is simplicity. They present it as very easy steps. Mark the range, wait for the 5-meter close, find the 1-meter retest. Repeatable.
And the efficiency, that's huge. Only needing 90 minutes of focus at the open, that's attractive.
Definitely a big draw. Then there's the rule-based nature. Taking the emotion and guesswork out of it, or trying to. If X happens, do Y.
They also pitch it as high probability, right? Because you're waiting for that 5-meter confirmation
And
close.
then using that specific 1-meter pullback retest entry, which they frame as the lowest risk way to get in.
And finally, you don't need a crystal ball about the whole day. No need for hours of pre-market analysis to figure out if it's a bullish or bearish day overall.
Right. The strategy just reacts to the price action right there at the open, using those levels from the first 15 minutes. It's purely reactive, not predictive.
Okay, so to recap this deep dive for everyone listening, we've looked at the first candle strategy from the Scarface Trades video. Mark the high-low of the 9.309.45 a.m. Eastern 15-minute candle.
Wait for a 5-minute candle to close outside that range. That's your confirmation.
Then drop to the 1-minute chart and enter on the first pullback retest of that broken level.
All strictly within that 9:30 a.m. to 11:50 a.m. Eastern window, and always aiming for at least a 2-to-1 risk-to-reward ratio.
The examples shown claimed a 75% win rate and $3,100 profit over one specific week using these rules.
And the key selling points highlighted were its simplicity, the very limited time commitment needed, and that rule-based approach trying to eliminate discretion.
Which brings us maybe to a final thought, building on that day 5 example.
Ah, the day with no trade.
Yeah. The author showed a day where the setup just didn't materialize within their 90-minute window, and they simply didn't trade, stayed flat. What does that tell you, perhaps, about the discipline needed, even with a system that seems so simple and rule-based on the surface?
That sometimes the best trade, the most profitable action you can take, is actually taking no action. Because your specific conditions, your precise rules, just aren't there.
Exactly. It suggests that following the rules also means knowing when not to engage. Maybe that discipline is just as crucial as the entry signal itself, something to think about.